What should you know before you file for Social Security benefits? That's the topic I want to talk about in today's short webinar. And as always, this is for educational purposes. This is not individualized advice. But we're going to cover three main questions today. Number one, will Social Security be there? Number two, how can you get the most from your Social Security benefits? And number three, how does your claiming decision affect your overall retirement plan? Three very important questions. Will Social Security be there? The most recent trustees report, which was released in April of this year, 2023, lets us know that the Social Security program is on an unsustainable path, as we've known, and that the trust fund is going to run out of money in 2033. And when that occurs, then benefits to be paid will need to be cut by 23%. Now, why would benefits be cut as opposed to eliminated? It's because the Social Security program is a pay-as-you-go system. They collect Social Security taxes and they use those current taxes to pay current benefits. To the extent that they collect more than they need, they put that in the trust fund. To the extent that they're paying out more than they're collecting, then they dip into the trust fund. And we're in a situation right now where they are dipping into the trust fund. And when that trust fund runs out, then they will need to reduce benefits to match the revenue that is coming in, unless they make some changes. Now, we were here in 1983. The trust fund was going to run out in 1985, and they did make some changes. They phased out the full retirement age, started taxing benefits up to 85%. So they made some changes at that time that turned it around, and they can do that again. They can change the start date. They can change the earliest date that you can collect benefits. They can reduce the cost of living adjustment. They can reduce the amount of delayed retirement credits that you can get for waiting beyond full retirement age. They can increase the taxes that are paid into the system. And that's the one that's been talked about the most, beginning to add a tax, a Social Security tax on income over $400,000. That has not passed, but that has been part of the recent conversation. And we'll just have to wait and see what they do. In the meantime, you want to make the best decision for your Social Security benefits for you and your spouse. And we're going to talk today about the three categories of benefits: your retirement benefit, your spousal benefit, and your survivor benefit. And you want to think through all three so that you can make the most of all three. The first is your retirement benefit, and that is your benefits on your own work record. You can find out what those benefits are projected to be by setting up an account at ssa.gov, the Social Security website. Set up an account. You can review your earnings history. You can look at projections of your benefits. But basically, to collect Social Security benefits, you need to have worked 10 years. You can earn 4 credits a year. You have to have earned 40 credits. So a minimum of 10 years of work would qualify you to get Social Security benefits. When they calculate your benefits, they're going to use your 35 highest years of earnings. So if you have less than 35 years of earnings, then there'll be some zeros that are included in there. And those are some things to know. Your benefit is then calculated for your full retirement age. And your full retirement age will depend on the year that you were born. Before the 1983 amendment, the full retirement age was 65 for everybody. But in that 1983 amendment, they phased in some later ages as the full retirement age. So now it's between 66 and 67. And that full retirement age is the key to how your benefit is calculated. At full retirement age, you get to collect 100% of your benefit. They call that the primary insurance amount. There's a whole formula that goes into calculating what that is. You can start benefits early, as early as age 62 on your own work record, on your retirement benefit, but you'll get a reduction of 70 to 70, 25 to 30%. You'll get 70 to 75% of that benefit at age 62, depending on whether your full retirement age is 66 or 67. And it's important to understand that if you do that, you have locked that in when you get to full retirement age, you don't get an increase because you've now reached full retirement age. If you start early, you're locking that benefit in. If you, on the other hand, decide to wait to collect past your full retirement age, you'll get an increase in benefits of 8% delayed retirement credit per year that you wait. So that means your benefit would increase by 124% to 132% of your full retirement age amount, depending again on what is your full retirement age and how many years of delayed retirement credits do you receive. Beyond age 70, there's no further increase. So there is no reason for anybody to wait past age 70 to collect Social Security benefits. You get no further increase. Again, if you wait, that is a permanent increase, and that can play into the benefits that your spouse would get or that other people eligible to claim on your record would get. But when should you start? Should you start at age 62 as at the earliest time you have the ability to start, or should you wait to age 70 at the very latest, get the most in delayed retirement credits? This is an important question. And you want to think through your situation. You want to think through your health, the longevity of your family, your spouse's health, the longevity of your spouse's family, and consider what the break-even point is for starting early or starting later and how that compares to your expected life expectancy. Is your break-even point going to be in your late 70s, in your early 80s? And how much past that point in time will you live to see the benefit of having waited? How much past that point in time might your spouse live to see the benefit of having waited? And so that's an important consideration. Of course, it's not the only one, and we'll talk about that more in a moment, but let's look at an example of a worker that has a $2,000 a month full retirement age benefit with a full retirement age of 66. This person could start their benefit at their full retirement age and collect the full $2,000. They could start their benefit at age 62 and they would get a 25% reduction and they would receive $1,500 a month. Or they could start their benefit at age 70, wait to age 70, get 8% a year delayed retirement credit and get $2,640 a month. And again, all of those would be permanent, whatever age they started. Now, does your benefit increase after you've started? And the answer is yes, it does increase for cost of living adjustments. Those are announced at the first part of the year each year. And that began actually in 1975 as an annual cost of living adjustment. Up until that point, there have been a few ad hoc cost of living adjustments, but nothing official or regular. We now have that every single year. The first cost of living adjustment, as you can see, was 8%, but it's averaged 3.78% since that time. And in the last 10 years, about 2.5%. And that's actually come up because the last couple of years, we've had high inflation that has pulled that average up for this last 10 years. But one thing that you really want to understand is that the cost of living adjustment does not typically, for most retirees, keep up with the actual increase in living expenses. The Senior Citizen League did a study in 2018, and they looked at an 18-year period of time, and what they noted was that for the average retiree that they studied, their Social Security had increased by 46%. But their actual living expenses had increased by 96%. So the Social Security was keeping up with about half of the increase in their actual living expenses. And so you need to know that there will be a gap. There will be a gap as you're going forward in what you need to cover versus what you're collecting. Now, I often have retirees say, I'm spending the same amount that I've always spent, and I'm not doing anything different. I'm spending on the same exact things, and I've got the same income sources coming in, and yet things just seem to be tighter than they were. And it's because of this. There is this gap in the increase in your Social Security versus the increase in your living expenses. And you want to have a plan for how you're going to cover that gap. Now, the second benefit is your spousal benefits. And this is a benefit available on your spouse's working record. A divorced spouse can also receive a spousal benefit on the same working record. That's if they've been married at least 10 years, they did not get remarried, and their own benefit is less than the spousal benefit. The spousal benefit is half of the working spouse's record. So the primary worker has 100% of their benefit at their full retirement age. Their spouse can get half of that benefit at their own full retirement age. The spouse can start it early. There is a little bit bigger reduction in that, 30 to 35% reduction. And they can wait and start at beyond full retirement age if they want, but there is no increase in the spousal benefit. There's no increase for starting beyond full retirement age. Now, they're limited in the fact that they can't actually start it until their spouse has started their own benefit. That used to not be the case, but that is what the Social Security considered a loophole, and they closed that. So the primary worker has to turn on their benefit for their spouse to be able to turn on their spousal benefit. Let's look at a couple of examples. And in this first example, let's consider a spouse that never worked. And let's assume that the worker has that $2,000 a month benefit that we looked at a minute ago. The spouse could get half of that at their full retirement age. So if their full retirement age is 66, then they would get $1,000 a month at age 66. They could start it early at age 62, and they would get $700 a month. But if they start past age 66, it's not going to be any more than $1,000 a month. What if this person did work and they worked some? And I often get asked the question, somebody has worked for a period of time and then they have stayed at home and raised the kids, and now the kids are grown. And I'm often asked, should I now go back to work and earn some more Social Security benefits for myself? And the question would be, well, is that going to make a difference or not make a difference? In this example, we have a spouse that worked some, and they have a benefit of $600 a month on their own work record. And their spousal benefit is the same as we looked at a minute ago, $1,000 a month. So in this example, this spouse could file at their full retirement age. They would actually receive their own $600 a month benefit and then get a $400 a month, what we call a spousal boost, to pull them up to $1,000 a month. If they start early, then both of those are reduced. Their own benefit is not reduced quite as much because they earned that themselves. But if they start late, if they wait past full retirement age, then only their own benefit will get those delayed retirement credits. And I specifically wanted to show that that doesn't necessarily give you any benefits. In this example, they wait to age 70. Their own benefit has grown by 8% a year. They can get $792 a month, but the spousal boost is reduced so that they still are only brought up to the $1,000 a month. And so that can play into the timing of when to start. In this situation, for this person to go back to work and have a better benefit than this spousal benefit, they'd have to almost double, the work history that they had. They'd have to bring that up to more than $1,000 a month to make it worth that. So they would want to work if there were other reasons that they wanted to work, but not to bring this benefit up at that late point in time. Now, the third benefit is your survivor benefit, and that is the benefit based on your deceased spouse's work record. A divorced spouse can also get a survivor benefit if they were married for at least 10 years and they did not get remarried before age 60. The survivor benefit is 100% of the deceased spouse benefit at their full retirement age. And if the deceased spouse was already receiving a benefit and that was a bigger benefit than their full retirement age amount, then the survivor benefit would be that bigger benefit that the deceased spouse was already receiving. The survivor can start that as early as age 60. So 2 years earlier, then you can start on your own retirement record. You can start at as early as age 60. It is reduced, and they can also wait past for retirement age, but again, there's no increase in the benefit for waiting. The only benefit that increases for waiting is your own retirement benefit earned on your own work record. So it doesn't make sense to wait past full retirement age if this is the benefit you're going to be turning on. It often makes sense to just go ahead and turn that on at full retirement age. But one thing that is very flexible and good for survivors is that they can switch between the benefits. And so let's look at an example of that. In this example, we have a survivor that has their own benefit under their own work record of $2,200 a month. So they can start early at age 62, get a reduced benefit, or they can wait to age 70 and get an increased benefit on that benefit. Their other option is their survivor benefit, which is $2,500 a month. That's 100% of their spouse's benefit. They can start that as early as age 60. It would be a reduced amount, or they can wait to do that at full retirement age, but there's no benefit to waiting past full retirement age. In this example, just looking at the numbers here, it would make sense for this survivor to start their survivor benefit between age 60 and 66, depending on whether they're working or not. And then at age 70, switch over to their own benefit, which would have grown at that point in time to be more than their survivor benefit. Now, if their own benefit was going to be less than $2,500 at age 70, there'd be no reason to switch. They would want to maintain the bigger benefit, whatever the case may be. Now, I want to talk about real quickly 5 factors that can reduce your benefits, and we'll run through this kind of quickly. One factor is if you are under full retirement age and working, you are subject to the earnings limit. If you are under full retirement age and you haven't yet reached that year that you're going to turn full retirement age, then your earnings limit is $21,240 a year. And if you make more than that, and you're also collecting Social Security, you'll have $1 taken back for every $2 that you're over the limit. So that can make it difficult to claim Social Security and still be working. Once you reach that year that you're going to reach your full retirement age, then the earnings limit goes to $56,520 a year. That's this year's number. And you lose $1 for every $3 you're over. So it's a much more flexible, much better limit and much less that is taken back. But it is still something that you have to look at. How much money would you earn from the beginning of year up until the month that you turn full retirement age? Is that going to be more than this earnings limit? And if so, how much would you lose? Now, the month that you turn full retirement age, you're then considered full retirement age. You can earn any amount you want. There is no earnings limit from that point forward, and there's no reduction in benefits. Now, if you did end up having to take Social Security and work, and you had your Social Security benefits taken back from you, then once you reach full retirement age, they will add back a small amount to each of your monthly payments to repay you what they took back from you, but they're going to spread that out all the way through to your life expectancy based on their tables. So they take it back pretty quickly in those few years and then give it back to you over a very long period of time. Your retirement benefit can also be reduced if you have certain pensions. If you have what is called a non-covered pension, where you worked in a location for an institution, for a city, for a municipality, for the teacher, as a teacher, whatever the case may be, you worked where you did not pay into Social Security. That's called a non-covered pension. You were paying into a different retirement system. Well, a non-covered pension will impact any Social Security benefits that you might have earned on your own work record through other work outside of that particular job, or that you would have as a spouse or survivor. So the impact to your own work record is called the windfall elimination provision. Your retirement benefit is reduced by the windfall elimination provision if you have a non-covered pension. It's not a huge reduction. In this year, in 2023, the maximum reduction is $557.50. It cannot be more than half of that non-covered pension that you're receiving. So if $557 is more than half, then it'd actually be a lesser reduction. And it begins to phase out if you have more than 20 years of substantial earnings under Social Security. It completely phases out if you have more than 30 years of substantial earnings under Social Security. The other pension impact, where you get impacted by having a non-covered pension, is called the government pension offset, and this impacts your survivor benefits and your spousal benefits. So your spousal benefit, that 50% of your other spouse's retirement benefit, or the survivor benefit where you get 100% of your other spouse's retirement benefit, those are reduced by 2/3 of your pension, your non-covered pension. So if you have a teacher retirement pension, you would take 2/3 of the teacher retirement pension that would be subtracted from what you would be eligible for under Social Security spousal benefits or Social Security survivor benefits, and there's no maximum reduction. There's no phase out of it. And so that's can be a much bigger impact on your benefits. And so it's important to know that when you're doing your spousal planning and trying to decide at what point in time would each spouse start benefits, it's important to know that this could be an impact. Another place that benefits are reduced is just through taxation. Originally, Social Security benefits were not taxed. And all the way, Social Security was written into law in 1934, and the Social Security taxation was part of the 1983 amendment. So there was a very long time where there was no tax on Social Security benefits. But we've now had tax on Social Security benefits since then. And the thresholds that are on this page have not changed since then. The way that you would look at how much you might pay tax on, you would take your adjusted gross income from line 11 of your 1040, you add half of your Social Security, you add back any tax-exempt interest from municipal bonds, and you add any excluded foreign interest. Whatever that adds up to be, you then compare it to these thresholds. So if you're a single filer and that number is less than $25,000, you have no tax on your Social Security benefits. If you are married filing jointly and that number is less than $32,000, again, you have no tax on your Social Security benefits. More and more people are being taxed on their benefits because it doesn't take a lot to get over those numbers. So once you are over that $25,000 and $32,000, you can be taxed on as much as 50% of your Social Security benefits. And then if you're above that upper threshold, which is $34,000 for a single filer and $44,000 if you're married filing jointly, then you're taxed on as much as 85% of your benefits. And it's important to think about that as well. You can do some strategic planning to increase tax-free income to reduce the amount of tax you would pay on Social Security benefits, because tax-free income is not added back to this formula. And tax-free income can come from Roth IRAs, it can come from health savings accounts. There's a number of places where you could pull in some tax-free income. And last but not least, your benefit can be reduced for IRMAA. This is your income-related monthly adjustment amount that impacts your Medicare premium. And it's a similar formula. You're going to take your adjusted gross income from your 1040, line 11 of your tax return 1040. You're going to add back tax-exempt interest. You're going to add interest from savings bonds that are used for education. You're going to add back any income earned abroad. You get this number and compare it to the thresholds. And if you're below that first threshold, then you just pay the regular amount for your Medicare and you have no surcharge over and above that. So for an individual filer, that is $97,000 this year. If you're married filing jointly, that's $194,000 this year. And if you're married filing separately, then it's the same as for an individual filer, $97,000. Once you're above those levels of income, then you're going to have a Medicare surcharge that's called IRMAA, and that will increase your monthly premium for your Part B and your Part D. And as you can see, it can get to be a very big number. So at the very top, you can be paying $560 a month for your Part B and an extra $76 a month for your Part D. Once again, you can do some strategic planning to increase the amount of tax-free income you have, because those amounts do not play into this formula. Tax-free income does not increase your IRMAA. Now, if you have filed and you change your mind, you have some limited opportunities to redo the decision that you made. You can completely redo it within the first 12 months. You pay back what you had received, and you wait and start file your claim later. Once you reach full retirement age, you can voluntarily suspend receiving your benefit and then turn it back on later. And you will get that 8% delayed retirement credit while you have suspended your benefit. If you're past full retirement age and you are thinking, well, I should have already filed. I don't want to wait to 70 because I think it's going to be better to have already filed for me and my spouse. You can do that, and you can ask them to give you benefits for up to 6 months retroactively. And it will be as if you had filed 6 months prior. All that said, that's a lot of rules and good information for you to use to think about your claiming strategy. But your claiming strategy needs to be coordinated with your overall retirement income plan, tax plan, all of the pieces of your retirement plan, so that you make sure that everything is working well together. To optimize your Social Security benefits, you want to take into consideration what sources of income you have, where they're going to be coming from, how each of those are going to be taxed, and what tax strategies you might be able to implement if you do or don't take Social Security at various points in time. And think through that so that you're making the best overall decision for your situation. And let's just quickly look at an example. Rick and Julie are getting ready to start their retirement income, and Rick has worked, Julie has not worked. Rick thinks he'll live to age 85 just based on his health and family history, and Julie expects to live to 90. Now, Rick saved as much as he could into his company plans, and so he's got 92% in tax deferred. What that means is when he pulls that out in retirement, that's going to be taxed as ordinary income. He doesn't have any tax-free at this point in time. A little bit that's in taxable, but mainly in tax deferred that's going to come out taxed as ordinary income. He's thinking that because Julie's going to live longer than him, that he should wait and start Social Security when he turns 70. And that way the survivor benefit will be the biggest benefit possible. And over their expected life expectancies, they would receive $980,000. Now, when we look at their numbers, if Rick starts Social Security when he retires, and Julie is then able to turn her benefit on at that same time, they will receive $984,000 over their retirement years. Same number of years, $4,000 more. And they've actually been able to start getting income coming into the household a little bit earlier. And because they have that income coming in, they're then able to do some planning with their investment strategies, with their tax planning strategies. And these are some things that improve their portfolio down the road and reduce their taxes over time, so that they can improve their overall picture. And so by doing the planning, they increase their lifetime Social Security income. They reduce their income taxes that they pay over their retirement. They reduce their market risk, improve the portfolio longevity, increase their probability of success. They have a greater value to leave to their children. So all around, they're very happy with the decision that they make incorporating their Social Security planning into their overall retirement plan. Now, what should you do? You're thinking about your Social Security. You need to run your numbers. That's the first thing. You need to run the numbers and look at what are your Social Security numbers for you and your spouse in the combination at different points in time. And then determine which claiming strategy is going to optimize your retirement plan. And if you're not sure, then consider getting some expert help to help you walk through that particular decision. Now, we'd be happy to give you a free Social Security strategy report. If you'd like to take advantage of that, you can email us. My email address is here. Just put free Social Security report in the subject line, and we will get back to you to provide that. And you can get more information like this by subscribing to my podcast, Retire on Your Best Path with Liz Whittaberry. You can find that on any of the podcast sites, Apple, Spotify, etc. And you can also get more information by subscribing to my YouTube channel so that you get notified when I put new videos, new educational topics out there. So feel free to go to YouTube, look up at Best Path Advisors and subscribe to that. And then there's a lot of good information at my website. When you navigate to www.bestpathadvisors.com, on the right-hand side in the menu, it says good stuff. You will find a lot of really good stuff there. It's free. You don't have to put in an email address to access it. I've got checklists. I've got blog posts. I've got podcasts. I've got my YouTube, a link to my YouTube. So a lot of good information there. And if you do want to have a conversation, you'll see that there is a Let's Talk button, and you can click on that and find a time that would be convenient to have a conversation. And with that, I want to say thank you for listening and tuning into this. My name is Liz Whittaberry. I am a retirement specialist, a chartered tax professional. I am the founder of Best Path Advisors here in Colleyville, Texas, and I'm here to help you be on your best path for retirement. Thank you again for tuning in.